Today on Trading Thoughts, we're going to be discussing the story of the week, Silicon Valley Bank, which has created major ripple effects and uncertainty within global financial markets. First and foremost, Will, I just want to find out from you, how can such a lesser-known bank, which Silicon Valley Bank was at this point last week, so few people had heard of them, create such a storm on a global scale and lead to major uncertainty within the banking system?
Yeah, so SVB was actually a fairly large bank, 16th largest in America. Mm-hmm. I think one of the reasons why a lot of people hadn't heard of it was based on its focus as a bank itself. Okay. It was mainly targeting these tech startup companies. Venture capitalists were all over that bank. Sure. Its client list, 97% of clients who worked with SBV had over $250,000 in a bank account there.
And that's significant, right?
It is significant. Figure. We'll kind of loop back to that, I'm sure later on, no doubt. That's part of the insurance that surrounds US deposit accounts. And obviously when this figure is breached, there's a lot of uncertainty to whether people will be able to receive their money back from the bank account in the event of insolvency, which obviously we later saw with SBV. Yeah. But yeah, to loop back on your question, it's primarily because its target wasn't retail, it wasn't you and I, it was those companies predominantly out of the US.
Specifically in the tech sector in Silicon Valley.
Particularly the tech sector. 50% of US startup companies had gone through SBV at some point, either currently banking with them or raised some kind of funding from SBV in the past. Okay. So it was a fairly niche sector within the banking sector itself.
Okay, so let's think about SVB for a minute. So you've already said they've got a very niche client base, and in some ways that does make you vulnerable to changes in the market. If you have a very specific area of business that you operate within, then if conditions change, then obviously you're going to be susceptible to risks. Now, what I kind of want to know is, how did the bank spring up so quickly? Because we've already covered the fact that it's a bank that specializes in working with startups and venture capitals in the Silicon Valley area. But again, it may well have been the 16th largest bank at this point in the US last week. However, that wasn't always the case. So when did it kind of become such a large bank?
Yeah, it saw a lot of popularity, just as the tech sector in general did across 2020 and 2021. Right, as a response to COVID, there was an environment where interest rates became super low. It was very cheap to borrow money. It created a lot of incentive for these companies to go out and borrow money, to a lot of these tech companies to go and start up. And in fact, if we look at the figures here, in 2019, there was $61 billion of deposits for SBV. And by 2021, that had quadrupled to $189 billion worth of deposits. Mm-hmm. So it just kind of gave you an idea. I know this is in kind of recent history, so we can still remember it, but it's one of those environments that was created where there was so much cheap US dollar around.
Artificially created as well.
Artificially created as a result of the COVID pandemic. There's a lot of stimulus. There's a lot of relief given to businesses and so on. And it was the stage that came before the inflationary environment that we're now dealing with, right?
Sure. So let's cover inflation then and interest rates, because they're obviously quite closely interlinked as a talking point for SVB. So inflation's high now. Interest rates have been increased by the Federal Reserve in order to try and cool inflation, which is fairly standard economics. But that wasn't always the case, because the Fed initially was saying that the inflation that we're seeing was going to be transitory.
Yeah, the transitory argument, yeah.
And what's happened? Because coming back to how Silicon Valley got into such trouble, a lot of this has come from the fact that they've got longer term securities held with the Federal Reserve, and they weren't expecting interest rates to be increased on a long-term scale. So what's actually happened here? Why are they in trouble?
I'd say they were a little bit naive with what the Fed were actually saying. When they told us that this was transitory, I think probably a lot of people would have looked at that quite skeptically. We saw the enormous amount, the tech valuations, for example. This is a tech-based bank, so we can focus quite heavily on tech.
And you can link them together, really, can't you?
Yeah,
the health of the tech sector is interlinked with the banks that they use.
Correct, and especially the startup side of things. There was so much wealth in 2020 and 2021. A quarter of all US dollars were created by that process across 2021. So what happened, a key error, a key kind of point historically in the SPV situation was, okay, when they received this $189 billion US of deposits in 2021, they needed some place to store this. They needed some place safe because they're inherently working with a riskier industry, that being tech. And so what they decided to do is go with long-term bonds, which would traditionally make sense. It's a safe place to store assets. And if the Fed were correct in their transitory comments, this wouldn't have affected things later down the line.
So just to explain how bonds work then. So say you're a bank and you've been given huge amounts of deposits. So let's say 100 billion as an example. You then go to the bond market, which are issued by the government, and say, I want to invest in long-term securities with the government, whereby I give you money and you pay me interest each year, right?
Yeah.
How does that go wrong? Because surely a government bond is the most stable thing that you can get on the market.
Yeah. So, I mean, actually, your example of 100 billion, the SPV real figure was 80 billion. So fairly close just by way of coincidence. But what happened is 80 billion of the SPV funds went to these long-term bonds, whereby they would effectively lock away their money for a set period of time. These can be 5, 10, 15, 20-year bonds. They lock these these funds away, and upon maturity of these, they'll receive a profit for holding them over that set period of time. So the issue really with these bonds, like I said, SPV, they put $80 billion US of this new money into long-term bonds. Okay, so they tied away all of this short-term deposits.
So much of it had gone into, so they weren't really diversified.
It wasn't diversified. No. Interestingly as well, I don't want to digress too much from this point, but across this period, while they were raising, the Fed were increasing their interest rates, there was actually no chief risk officer at SPV, which, okay, might not be relevant.
That's a major red flag though, isn't it?
It is a major red flag, because a lot of the other banks were, and we'll probably come on to the contagion part that's dominated headlines as well, but a lot of the other major banks were actually selling off some of these long-term bonds because they realized actually when interest rates go up, these bonds are less competitive. They're effectively currently worth less. If you leave them until maturity, it won't be an issue. But actually, a lot of the banks had considered, their risk management and started to diversify and sell off some of those long-term bonds.
SPV had made crucial mistakes then.
They were still stuck with their $80 billion US dollars
in super long-term
bonds.
Bonds, okay. So these bonds pay the bank an ongoing amount each year for holding money with the government.
Absolutely.
But other banks were diversifying and going for bonds that had been issued at a higher interest rate to match the environment, right? So
just for some context on this, by 2022, SBV had $15 billion US of unrealized bond losses. So it is unrealized because obviously if you held this until maturity, you'd still get back your original principal.
Sure, but it's based on what it's worth.
Yeah, you could only get rid of those for $15 billion US less than what they paid for them, right? So this created a bit of a problem. Also, as well, contextually, when you've got higher interest rates, these tech companies were less likely to use SBV for their lending requirements. So instead of a tech company, let's say you've used venture capital to raise X amount of finance, instead of you borrowing money from the bank, you're going to lean more heavily on your cash deposits. So all of a sudden in 2022, you've got this kind of nightmare situation for SBV where, okay, your bonds are worth less. Your primary client list is withdrawing all of their money to spend on kind of daily upkeep.
Because it's more expensive to take loans out at that point.
Absolutely. And a lot of these tech companies initially, as we know, aren't profitable. It takes them years and years of kind of
so they need the cash.
Cost bearing. Just for regular operations, paying
getting
employees.
Absolutely. So their depositors need to come and get their cash because loans are more expensive. The bank then needs to sell these securities in order to meet the needs of its depositors when they come to the bank to get the cash out. But these securities that they hold with the government, they need to sell on a secondary market whereby they're worth less only based on the fact that you can get higher rates from the government at this point in time. Yeah. So if someone was to buy that off them, you'd say, well, why would I want that at market rate
when I can get
something that pays me a far higher coupon from the government?
Yeah.
So these are not worthless, but they are worth less.
Absolutely. And this is what we saw on March the 8th. SVB, they are quite a digital bank. They tweeted that they were selling off their entire liquid bond portfolio. Okay. This was worth about $21 billion at the time. They could have, if they had enough liquidity, have held this to maturity and not made a loss on it, but unfortunately they had to, just to cover the liquidity that these tech companies were requiring, right? As a result, as often happens on Twitter, and when you start kind of using the more digital means of communication, some insolvency fears began to grow.
Yeah.
And as a result, VC firms advised the startup companies to start pulling funds away and withdrawing their funds from SBV.
I feel like
ended up in a situation where, $42 billion US. This figure is crazy, because across a 10-hour working day, that's $1 million US per second of withdrawals are occurring for SVB, which is, like we said at the start, this relatively niche, relatively unheard of bank. And all of a sudden they're experiencing these kind of transaction volumes. And it broke the server. So imagine this, right? You've already heard that you need to all of a sudden get your money out of this digital bank. Yeah. You assume that you can probably do this on your smartphone, or at least on your web browser. You log in, the servers are down. Okay, panic, you see on Twitter.
So you screenshot, you put that on Twitter, you say, I can't get my money out of the bank. That gets retweeted a few times.
Gets retweeted.
That forest fire spreads very quickly.
Very quickly.
And that results in the bank getting closed.
Absolutely. And this is why you then start to see the images of people queuing up outside banks and so on. And this is really where the fear of a bank run takes place, and the fear of a contagion takes place. Okay, it was kind of a digital bank run at first with the SVB. All of a sudden the servers went down and people were, physically, it manifested into a real life situation where people were queuing up outside banks and so on. And it spreads, of course, to those.
The US hasn't seen that for a long time, has it?
Well, since 2008.
2008. I mean, this is the second largest bank failure in US history, so it's a big deal. But no one really saw this coming. But I guess it does come as an effect of not reckless policy from the Fed, but such large moves of producing cheap money is always going to have a knock-on effect later down the line.
Definitely. And there's a few kind of red flag areas.
Okay.
That I find interesting to look at.
Specific to this case, or?
So we spoke about the chief risk officer not being present. They got rid of their chief risk officer. They went through a period of 8 months while the Fed were increasing their interest rates, of not having anyone look at their risk profile, looking at their portfolio where things are managed within the bank itself, which of course is a red flag.
Yep.
Secondly, Greg Becker, the CEO of SVB, he was on the board of the Fed Reserve Bank of San Francisco. So these guys are actually in charge of supervising SVB, and the CEO of SVB is on the board himself.
Major conflict of
right?
interest.
So there is a little bit. I don't want to speculate too much on kind of whether this is right or wrong. I'll kind of list off the facts and let the viewers decide for themselves, right?
Yeah.
But we've also got a situation where the CEO, CFO, and CMO of the bank sold a combined $4.4 million worth of SBV stock weeks before its demise. Now, hours before its crash, and this one is probably the one that strikes me as the most relevant, just because of the timeline of it, literally hours before the bank run, the employees of SVB received their annual bonus literally the same day of the bank run, literally hours before people were unable to access their personal money, right?
Okay, so are we going to see a domino effect? Is this going to start to trickle into the rest of the US banking system and then potentially into the global banking system? Or has the US government managed to sufficiently step in and, deal with the immediate concerns?
I'd say most at risk is the smaller regional based banks. So none of these kind of large time players that we look at, the HSBCs, the Goldman Sachs, the JP Morgans and so on, these large multinational banks will be absolutely fine. They may even benefit from a situation where the regional banks struggle.
HSBC picked up the UK part of SVB, right?
At £1.
£1.
Great deal. So we may be in a situation where some of these larger banks, there's a panic at the moment, and you might see some, short term, some of these stocks decline a little bit. But actually, across the long term, you are removing a lot of these smaller, like I said, regional-based banks that are probably looking after these small, medium-sized enterprises that perhaps based on their size have to have a fairly limited diversification of their profiles, and some of them as well can't afford as well. They're smaller regional banks; they can't afford the unrealized losses that a larger multinational corporation could absorb, right? Yeah. And we've seen that already. There's been a few banks in the US. Okay, Signature Bank failed, in a New York-based bank failed. Again, it was a regional one. We've also seen it across First Republic Bank, Pacific West, Western Alliance, and kind of a handful of others as well. Mm-hmm. But again, none of these really big name banks.
Okay.
But again, nonetheless, still a concern if you are, of course, banking with one of those regional banks.
So obviously, this is really alarming for the customers of SBV and Signature Bank. Has the government bailed out the depositors, or what's going on there?
Yeah, so the Fed have come out fairly urgently, as you would probably hope for and expect at this period. They've announced basically two key components to this recovery program, right? On one hand, all depositors, even the uninsured, so even if you have over $250,000, you will be covered by an emergency banking insurance scheme that the banks, are required to sign up to as a result of the 2008 global financial crash, right? Mm-hmm. So that's one positive. It's not a taxpayer expense. I have seen this circulating, on the internet and so on and so forth. It's not something that the taxpayers are footing the bill for, but rather it's something that the banks have been forced to comply with.
That's good regulation.
Part of their operation, yeah.
Yeah.
And the second part of it, I find this interesting. The whole reason that SBV failed was because it had to sell these long-term bonds, right, at a discount to what they are worth. The Fed have announced something called a bank term funding program, where all affected banks can sell their long-term bonds and securities back to the Fed without a loss, even prior to maturity.
Okay. So say it's trading at 20% or 15% below its maturity value, you can get it back at 100.
You can get it back, because in some ways as well, you can kind of point, SVB, I'm sure, will be pointing the finger at the Fed and saying, okay, well, this is kind of your guys' fault.
Yeah, you increased the rates too quickly. A quick rate that it made all of the bonds that we held with you completely unattractive and unaffordable to keep.
Unaffordable. So there's a few kind of, I'm sure there'll be many fingers pointed around the board, but it's a good incentive. It should kind of shore up some confidence that even some of these regional banks that perhaps have some of these long-term bonds, there's a bit of a get out of jail free card. Okay, they might have messed up. They might maybe a little bit too, under diversified. They may be a little bit too exposed to that market.
Sure. Just
offload them.
Okay, thanks, Will, for clearing up what is a very shaky situation in global financial markets. This came out of nowhere, or at least most people feel like it did. It sounds like the people at SVB had a bit of an idea that something was coming based on what you said in the middle of our conversation. But for most people, situations like this do create a lot of uncertainty. And it's really important that people within our industry do get our heads around it and clear it up as quickly as we can. What do you think this demonstrates for investors when it comes to exposure to companies like SVB? Well, thanks for coming on the show today and clearing up the situation which has created so much uncertainty in the past week.
Thank you, Ciaran. Thanks, sir.